Welcome back. Lots and lots of earnings have been coming in. So let's straight away get to our first corporate conversation of the morning. The company on our radar is Deepak Fertilisers. The growth has been fairly steady, actually. Just to recap the numbers, I'm looking at Q4 revenues up 28%. The margin has declined by almost 300 basis points. So we have to get into that. Profit is fine, up about 20%. And as far as the year is concerned, it's been a fairly good year for Deepak. Top line growth of 18%. Margins have expanded to 19%, and the profit has doubled this year for Deepak. So let's find out what the trends are like and what the outlook is. Mr. Sailesh Mehta, Chairman and Managing Director at Deepak Fertilisers, is with us. Mr. Mehta, good morning. Thank you very much for joining in. So, let me just start there to understand what's been happening, because in your fertilizer business has been doing very, very well. But the mining chemical segment and the pharma specialty segment, that's where, perhaps one can argue that growth has not been as optimal as you would have liked to see. Fourth quarter trends, let's first go into this margin compression. What is a more sustainable level of margin? You're at 18% EBITDA margin in Q4. What are the factors at play, and what is a sustainable margin we can expect this year?
Sure. So broadly, we have now evened out at 18-19% margins. And as we move towards more and more of specialty, we will see a margin expansion coming in. And in terms of sustenance, if one were to see what has transpired, what has brought this kind of a result, and as we see an increasing trend, fundamentally there are three things strategically at play and which are now getting more and more validated. Number one is the beautiful alignment that we have with the India growth story for all of our three businesses, whether it is in terms of coal for power sector, or limestone cement for real estate or infrastructure, which is where the mining chemicals is beautifully aligned. Then when we come to fruits, vegetables, horticulture, which is where our crop nutrition business is beautifully aligned. And similarly, as India grows into the pharma sector globally and the specialty chemicals, that's where our industrial chemical group is very beautifully aligned. So the first aspect strategically which we are seeing, which is bringing sustenance, is this beautiful alignment with the India growth story. There's a very good tailwind.
No, absolutely. Long term, no doubting that. But it's just the short term issues that we have to kind of go by. Mining and pharma, let's focus on these, because here the growth has been either low or slightly patchy. So if you could tell us, in FY25, your mining chemicals growth was just about 3%. It seems that there were some capacity constraints with respect to nitric acid. Now, tell us, how much will this business deliver? What is the top line growth? What is the kind of margin profile? Because even here you have your premium or specialty products, like I think this product called LDAN, if I'm pronouncing it right.
Yes.
So let's talk about mining. What is the volume growth you're expecting in the business this year, and what is the margin at which it will operate at?
So, we are almost reaching 100% capacity utilization, and which is where the new project that we have taken up at Gopalpur, where we are adding a substantial, capacity that will kick in, by H2 of next year. So that is going to be coming in a very timely fashion. Having said that, you're right that in terms of this shift from commodity to specialty, that is also something that is going to help us, shore up the margins as we go forward. Fertilizer side, as you're aware, we have virtually moved over from commodity NPK to crop-specific NPKs. And that is getting very, very positive feedback from the marketplace. In case of ammonium nitrate also, as rightly so what you have pointed out, we are the only ones who make the whole range, melt, high-dense product, low-dense product, right up to the hospital grade, which gives us, the segment-based strengths.
Sure. Mr. Mehta, just a question. Since obviously it is the move higher up on the value chain on specialty products that's going to drive your, your margins and your overall P&L profile. You're at 22%. I think out of your total revenue, 22% came in from specialty products as of the end of last year. What is the scale up you're expecting this year? And I go back to my margin question then. You ended last year at 19% EBITDA margin. As the share of specialty products goes up, can the margin go to 20, or is 19 the best case?
No, so there is now going to be a faster move towards specialty, because, the proof of concept is now already settled. The market has accepted. And there is a very good positive, I would say, push in terms of acceptance of the specialty products. So now the journey will be faster. We have also done something else from a restructuring perspective, which is going to get much more focus on specialties. All the businesses now we have unwind and restructured into separate corporate entities, where the focus, right from the board member to the lowest officer, is going to be specifically on that project to deliver these specialties. So the journey that we see now on is going to be a lot faster. And in a sense, because different products will have different premiums, I'm not in a position to precisely say, but it is overall going to, give a very positive fillip to the margins.
Okay, all right. Hi, Mr. Mehta. Good morning. Nigel on this side. A couple of numbers before we let you go. As you've told us in the past, you're debottlenecking, you're getting the ammonia plant, you're getting the technical ammonia plant as well up and running, which will help your growth. What is the debt in the books currently? What is the capex plan you have for this year? And by the end of this year, what kind of your debt will you have in your books, sir?
Sure. So broadly, as you are aware, we have taken up projects now further enhancing the capacity of ammonium nitrate and further enhancing the capacity of acids. Both the businesses where we have been there since the last 40 years, and both are riding on the India growth story. And that total investment would pan out to be close to around 4,500 crores. We are, I would say, a year and a half away from commissioning. And in terms of the debt, it's around 3,500 crores out. We brought in a reduction with the last year's cash, positive outflows, where we brought in a reduction of 120 crores. And going forward, since all of this debt is tied up, and including the interest cost has been incorporated in the project kind of thing, we don't envisage any issues as far as
But the debt goes up, right? To what level?
That would go up to 4,500 crores at a peak level. Of course, it will come down as we see the older projects now contributing more and more. Recently, we have also done CCD capital infusion of 800 crores. So that is also bringing a much better balance sheet in terms of the debt equity for the projects and other needs.
Okay. All right. 4,500 crores. Got one number. Second number, what about the revenue growth for the year in percentage terms? What will it be?
So we are seeing a very even keel. And, as we see things pan out, as we are all aware that predictions are good rains. So from that viewpoint also, all our businesses will get a positive flip. So we look forward to continuing the same positive trend.
So mid-teens growth for the year?
Yes, I think it's in the right direction, as you say.
Okay. All right. Thanks a lot, Mr. Mehta, for joining in. We'll hold you to these numbers. Wishing you all the best for the coming year as you focus more on specialized versus commoditized products across your segments.
Indeed.
Good speaking to you.
Thank you.
Well, let's